Hi, Jags. This is Fahad. Today is Tuesday, October 27th. Let's get started. I have Chronicle here with me. Hi, Chronicle.
Hi, Fahad.
Today, we wanted to bring this episode two to the investing series in Jaguar Media that we started a couple of weeks ago. As you saw, that we had our first presentation that went out not too long ago. This is the second one. And in this case, we're going to discuss this very interesting company, a home builder from Florida called St. Joe Company, symbol JOE. As a reminder, this entire presentation will be uploaded in Jaguar Media once it's compiled, along with full research note and the slide deck behind it. And so with that said, let's get started. So Chronicle, tell me about it, St. Joe Company.
Sure. So before we begin, as a side note, we always try to keep the video short, but with this company, there's no way we are going to be able to hit on every single point. But the attached write-up will give you the full picture and entire bull case. So let's get started on the second slide here. All right, what is St. Joe? The simplest explanation would be they are one of the biggest private landowners in Florida. If we look at pages two and three of our note, you'll see that most of the land ownership can be traced back to Alfred DuPont and his brother-in-law Edward Ball back in 1930s. They took advantage of the Great Depression by scooping up all this land on the cheap. And then after DuPont passed away, Edward Ball went on to set up St. Joe Company as a paper mill while keeping ownership of all that land. But fast forward to today, they're no longer in the paper business. Instead, what they're doing is finding ways to monetize all that land. So here's the breakdown. 48% of their revenue comes from developing the land into real estate, both residential and commercial. 36% comes from the operation of the hotels and leisure properties that are developed on their own land. 12% comes from commercial and retail businesses that are again built on their land. So either they're operating these restaurants and shops themselves, or they're collecting rent and leases. And lastly, they also have a very small timber business because of the forest that they own.
The housing and the real estate segment, which is the largest piece of the total business, 48% of revenues, that's the part that is the most fascinating to me in your research note. Um, this company has lots and lots of undeveloped land all over Florida. Some are very, very prime locations on the ocean, and some are in the suburban areas. A little bit more color onto this, and what is the average price of these selling that they collect for selling these homes, and are these very highly desirable locations, or where they are generally located in Florida?
Most of their properties are located around Panama City Beach, so along the coastline, along the Gulf of Mexico. I think about 90% of their projects are within 15 miles, 15 to 20 miles of the Gulf. As far as pricing goes, St. Joe goes after the affordable and entry-level market, so most of their properties land between $300,000 to $500,000.
Excellent. Moving on to the next slide. This is part one of the financial statements. Tell me about it. There's a long term, lots of things have happened in this company, and I was looking at the long term chart of past 10 years. This stock used to be a very, very hot stock long time ago during the housing bubble. Then it came down sharply, and then it stayed at this level in the teens, high teens to low 20s level for a long period of time, good 6, 7 years before it recently started to break out on very heavy volume. What do you see in the financial statement that has been a turning moment for this company?
So part of what makes St. Joe such a misunderstood company is that if we were to just look at the headline figures like revenue, EPS, and operational cash flow on a historic basis, we're not going to get anything out of it. I mean, these graphs are kind of incomprehensible, right?
Right.
Which is partly why the stock has gotten ignored for most of the last decade. I won't go into the entire history, it's all in the write-up. It's safe to say the company went through lots of ups and downs over the last couple decades, but the important point here for this presentation is that the company went through a management change and they installed a new CEO, Jorge Gonzalez, in 2015. So now on to the next slide. If we isolate out the period since Jorge Gonzalez took over, So after the company cleaned up its portfolio and sorted out all its previous problems, we will see that the numbers have quietly gotten much less volatile and more predictable. First thing that stands out here is a clear strategy where the emphasis has been on growing real estate development relative to other segments. Second of all, margins have improved across the board in a consistent and organic fashion. This is due to a cut in sales and marketing costs, as well as property price appreciation from macro conditions in residential real estate. On top of that, the company is also beginning to enjoy operating leverage within its hospitality and leisure business. In fact, St. Joe now enjoys over 60% gross margins in its real estate segment, as well as up to 110% return on capital in their residential projects, despite the entry-level pricing. So when sell-side and algos are glancing at historical EPS and revenue, this is what they're not seeing under the hood. Lastly, this is not shown here, but it's in the write-up. St. Joe also has a solid balance sheet with no debt problems. There should be a chart somewhere on pages 6 to 8, which shows that the company managed to grow real estate revenue without taking on additional debt.
In real estate business, maintaining gross margins of this significant 50% and operating margins of near 30%, that's very, very impressive. Clearly, the company has been able to turn that around because looking at these charts, if you go back to 2015 and 2016, the operating margins were negative and they were just starting to inflect positive. But then, really beginning from 2017, they were able to improve profitability around the company materially since that new CEO was installed. And this is now speaking for this trend that's many years later, this as a stock is starting to break out as it benefits from COVID-led disruption and the migration that is taking place. Moving on to your next slide. So this is really a turnaround story. The home price index continues to move higher steadily. We have seen this across the country. We have covered a lot of other home builders that have benefited from this theme as well. And I believe this is a steady trend that will continue to play out for many more quarters to come. What else would you point out over here as a significant driver of stock performance for St. Joe from here?
Yeah, so this housing undersupply theme is something we've detailed multiple times already. We've gone roughly a decade from 2009 to 2018 with historically low level houses being built, which has resulted in very little inventory. And so it's no coincidence that all the home building companies like Lennar, D.R. Horton, Pulte Group, they've been repeatedly reporting blowout deliveries, orders, and backlogs lately. And also notice how US housing macro data and home builder confidence have been remaining stubbornly robust. This shouldn't be surprising given how the industry now has to make up for that roughly 10-year period where, after the GFC, where everyone was too scared to build. And so it's going to take at least several more years of elevated activity to catch up, we think. And staying on the high level view, according to the US Census Bureau, Florida has seen net inflows of 1.1 million over the last decade. From 2010 to 2017, the state had the highest domestic immigration inflow nationally, and then again in 2019. As a result, both rental rates and home prices have been rising steadily, not just in the Florida metros, but also in the Panama City Beach area, which is St. Joe's main turf. And the fact that this is a popular retirement destination helps the company too. If we go to the next slide, so this table and map illustrate the company's disclosed current projects going on. They currently have at least 23 different projects going on, compared to just 9 at the start of 2019. Now, if we look ahead, the company has 120,000 acres of valuable land spanning Panama City Beach and Walton County, the southern part, which management has identified as the next area they will focus on developing. That's the areas that are shaded in dark pink, which I'll touch on in a couple slides. So that's the residential side of the bull case.
Very interesting. These are a lot of projects. That's a lot of projects that are going on. We've also seen a major trend develop that a lot of people are moving out, for example, from New York City and California markets And COVID has accelerated the shift into areas such as Florida, which is seeing a net immigration or the population growth, while the state of New York is seeing a population decline. Those trends are also benefiting the company. And I think that's another reason why to continue to remain bullish on a lot of home builders. And this one just plays into that theme. Moving on to your next slide, as the turnaround story continues. Let me, before we go into this, because this one will touch upon a little bit on the commercial side. Are you worried about the little bit of exposure the company has to its hotel business and some retail locations, or that's not a concern at all?
So it's understandable. We may be tempted to think that because of the pandemic, St. Joe's businesses within this segment may be suffering badly, but that's not the case. In fact, the segment is only down single digits through the first half of the year. And in the Q2 earnings, management actually highlighted that COVID-19 has helped to increase local tourism in Northwest Florida because of locals wanting to get away from, Miami, Tampa, and Orlando, but at the same time not wanting to risk long distance travel. So St. Joe has actually been a beneficiary. If we look at the company's latest update released on October 15th, the company is in the midst of constructing another roughly 700 hotel rooms, retail units, and offices, which is going to contribute to their 2021 goal of 1.5 million commercial square feet. So they're not doing this because they're seeing less demand. They're actually seeing more because of COVID, and including first time visitors. If you look at the commentary that's on this slide. Last thing I want to touch on here is operating leverage, as shown by the chart on the right. One thing about this segment is that St. Joe's expenses from operating its hotels and retail centers don't really go up all that much as traffic increases. In fact, their expenses for the segment have actually lowered from $50 million in 2015 to roughly 40 million in 2019. So in the future, additional business is likely to lead to acceleration in operating income rather than linear increase. And on page 10 of the write-up, I also touch on St. Joe's operating leverage when it comes to their membership program.
I was looking at their offline. I was looking at the earnings estimates, and one of the exercise that I like to do is I like to take a look at how the consensus on the street is building and whether it's starting to move up or down, with the stock price as well as with the management commentary. And based on all the things that you're describing, particularly related to residential commercial market, I have not seen the forward earnings estimate start to move higher any materially. And if there is a reason to believe that the residential segment of the market will remain very, very strong for this company, while the recovery on the commercial side will be slower, but it will still be there. I think with all the land that they're sitting on that is going into development, there's reason to believe that those forward earnings estimates are still too low. They're going to have to play catch up, and that means multiple expansions as well as earnings expansion. I also particularly like this comment from the second quarter from the company about its commercial business, where they're talking about the reopening theme, how it led to a immediate spike in the occupancy rate, and the daily rates for its hotel chains basically quickly went to a summer season levels, the highs, and then they exceeded their internal expectations as well. I would expect that trend will also continue as the fear of COVID gradually goes away. Moving on, to continue to talk about the turnaround story, tell me about this one.
Sure. So this is the part right here that's really the upside catalyst to the estimates that you just talked about. So in the write-up, I made the argument that St. Joe's turnaround story actually already began in 2019. Like if you take away the special one-time benefits from the 2017 and 2018 income statements, like tax benefits and land sale deferrals, you'll see that accelerated growth in St. Joe's actual businesses is already there. So this has been hidden. On top of that, this is now a much different company than what it was for most of the last 2 decades. So that the bear case is no longer valid, and we cannot be looking at historic EPS and revenue. But here's the thing: it's good knowing all of this, but what good is it if Wall Street doesn't notice the actual growth that's taking place underneath the headline numbers? In which case, the shares are just going to continue going nowhere, right? So we're going to need a catalyst, and the catalyst is going to come next year. Like if we look at the table on the right, management is guiding to 1,000 home sites being sold per year starting in 2021. And this is compared to 379 in 2019. And at the same time, hospitality and leasing revenue are also expected to improve. And this presentation right here is hidden a few clicks deep within the corporate website. And so when this happens, we'll finally see that sharp acceleration in EPS and revenue, which is what Wall Street is probably focusing on. Now, going to the final slide, just as we just mentioned, management is expecting 1,000 home sites to get sold. Even if we conservatively assume less than 1,000 home sites sold, like let's say 900 with gross profit of 60%. And then even if we keep hospitality and leasing and timber growth flat, even under this conservative scenario, the operating income should already work out to slightly above $70 million for 2021 versus $30 million in 2019, or roughly 125 EPS versus 0.45 EPS in 2019. So that's your catalyst right there.
So that's 150% growth rate in operating income or earnings per share with the most conservative view that we can take with, if you take whatever the company is telling us itself, the CEO that is, and we basically apply more conservatism to that, we get to a growth rate that looks very, very strong. 150% from 2019 to 2021. And that's what I mean, where a lot of the times, the stocks can stay dead for quite some time, but then they start to catch up as the forward earnings expectations start to move higher and the analyst community finally realizes that the trend is changing materially, and then you start to see the upgrade cycle come in, resulting even more and more growth. Just high level view over here, but based on this, what do you think? This company, could it become an M&A target? I mean, this is $1.5 billion in market capitalization, holding on to significant amount of land in key spots such as Panama City Beach in Florida. What's stopping from somebody like Toll Brothers from coming in and just scooping up the company? It seems quite depressed to me given where the stock has been and the kind of assets that the company is holding with very low levels of debt.
I never gave it that thought about it being an M&A target, but even without the M&A, I think there's still a lot of upside to be had because looking at the rest of this list under the bottom line, all this stuff that we've already touched on, the last thing I would add here is that um, you know management has already proven capable of growing real estate revenues without taking on additional debt. And so this is going to lead to accelerated growth in cash flow when revenues begin to ramp because there's operating leverage here.
Yeah. Folks, one thing that you will see when you pull up the long-term chart of this company, you will see how the stock for many years, has been settled in the mid-teens and to high teens, and then multiple times it came up to $23 resistance, and then after failing at that resistance, just very recently we had a high volume spike and it started to break out from that resistance. And so now the setup is here on a long-term weekly scale, and you'll see that chart in the research note as well that is going to be posted on the website, how this thing is pushing up and now starting to clear a lot and a lot of resistance. As I normally say, the bigger the base, the higher in space, and that's exactly the setup here. Now, Chronicle, you have a long-term target with the stock trading around 25 right now. You have a long-term target of $40 to $45 per share on this, in the next 2 year period. So you're looking for almost 100% return, 80% to 100% return on this name. And I'm assuming that it's going to be this long only to after factoring in, because we have to see some of these mega trends continue to play in the favor and the upgrade cycle continue to shape up over time. So naturally it will take some time, but that seems very ambitious, right?
So as ambitious as it sounds, I've actually projected this price target from these conservative estimates that I just talked about. So using the conservative estimate of 2021 as a base, I then project another conservative estimate into 2022, and that's how I ended up with 40. So it's actually a very conservative scenario here.
So your 80% upside from here in stock is actually, I quote, conservative over the course of the next 2 years. Very interesting. All right, folks, this will end over here. Thank you very much for joining. I'll just say this in the final words over here. We have been very bullish on housing stocks for quite some time, all year long, particularly in the last 6 months or no. We have presented a ton and ton of bullish cases on many, many different stocks. Here's a company that I believe and Chronicle believes, based on its presentation, that is quite undervalued. The company has huge exposure to some of the very hot markets in Florida, sitting on massive piece of land, and the company's debt ratios on the balance sheet are very, very low at only 0.5x. Long history over here. And who knows, this is one of those jewels that could basically just take off and continue to run from here. It's one to monitor. I really like this one, and I may jump into this myself and just buy it for my long-term account. So fantastic stuff, Chronicle, as usual. And this is an investing series, episode 2. We'll see you next time.